The Bank of Canada began what is being called one of the most aggressive interest rate hike programs in history today by instigating a 50 basis point increase to interest rates, the biggest increase to interest rates in 22 years. And they are making no bones about it. Inflation is a problem and they are going to fix it. And that and what it means for your mortgage is what we're going to talk about in today's video. And don't necessarily think that this means it's time to lock in, because maybe for you it is the right time to lock in, but maybe it isn't. We're going to talk about that at the end of the video, so stay tuned for that. The definitive guide on how to manage your credit. Product, penalty, price in that order. It's never been more important to get your mortgage right. All right, so welcome back. As expected, the Bank of Canada increased interest rates by 0.5% today. That is the first time in 22 years that they have gone that far when increasing interest rates. And it's widely expected that this is just the beginning of one of the most aggressive interest rate hiking campaigns in history. But that doesn't necessarily mean it's time to lock in your mortgage. It doesn't necessarily mean that variable rates are a bad idea or that fixed rates are a good idea or vice versa. But what it does mean is that the Bank of Canada is addressing the inflation problem, and they're going to do everything they can to snuff it out so that we don't end up in a situation like in the 1970s where we saw massive stagflation. And for those of you who don't know, stagflation is when you have high inflation and low growth in the economy, which is the furthest thing from what we have right now. And Tiff Macklem is definitely set on making sure that doesn't happen again. We're using the lessons of the past in order to make sure that they don't happen again in the future. But before we get into all the details, before we talk about the rate hikes and the other things they talked about and why they made such a big rate hike, do me that favor, hit the subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. We are just 1,100 subscribers away from giving away $5,000. But in order to win that $5,000, and in order to find out what you're going to have to do to enter the contest to win it, you have to be subscribed. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. All right, so let's jump into the headlines as we always do. If you're new to the channel, we like to pull up and see what the news is saying about what is happening, and then we'll dig into what the Bank of Canada actually said. We'll pull up their articles as well. But here's the headline: Bank of Canada delivers jumbo rate hike with more to come. And it is quite clear right now that we have had a pretty significant period of inflation. It's quite clear that something needed to be done from an interest rate perspective, and they have begun to do that by raising interest rates by 0.5% today. Now, by the way, if you're in the market for a mortgage and you are looking to choose a fixed rate mortgage, you don't really have to worry too much about locking in a rate, although we always suggest that you do that as fast as possible, because the market widely expected this, and as you saw in March, fixed rates went up about 1%, expecting this rate increase and the subsequent rate increases that will follow to happen. So this is already very much priced into the fixed interest rate market. Now, it's been 22 years since we've seen a rate hike of this much in a single interest rate hike, and the Bank of Canada was really clear in why they're doing this. They saw three main things that they needed to address. The first was the continued growth in the economy and the very low unemployment rate. The second was obviously the high inflation rates that we are seeing right now. And the third was the reason that, quite frankly, higher interest rates needed to come. And there's some interesting things to note here about the forward projections with respect to interest rates, which we will get to in a couple minutes here. But before we get into that, I do want to discuss inflation and the updated outlook for inflation, because this time around in April, they released their quarterly monetary report, which means they've given us a whole bunch of data and a whole bunch more information. And they've revised a lot of the projections that they had from January, including the inflation projections. And what I'm going to do is I'm going to save you from actually having to go into the monetary policy report, but I am going to pull you this quote from the Bank of Canada news release. It is this: CPI inflation in Canada hit a 3-decade high of 5.7% in February, above what we projected in the January MPR. We now expect inflation to average almost 6% in the first half of 2022, and it will remain well above our 1 to 3% control range throughout the year. We expect it to ease to about 2.5% in the second half of 2023 before returning to the 2% target in 2024. So this is really interesting commentary. Obviously, they're expecting inflation to remain high for longer, and a lot of this has to do with the Russia-Ukraine crisis and the impact that that is having to inflation. Now, the impact of that crisis isn't expected to affect growth in Canada very much. However, it has had a pretty significant impact on inflation due to higher energy costs, higher commodity costs, and basically continued supply chain interruptions caused by that conflict that the Bank of Canada and, quite frankly, central banks around the world were hoping were going to dissipate over the beginning of 2022. And I did find one table really interesting in the monetary policy report. That was this one. It's table 3A, and it's the impacts of Russia's invasion of the Ukraine on Canada growth and inflation. And what I want to point out here is that the inflation problems that we had have been exacerbated by the Ukraine and Russia crisis. With respect to inflation, we have basically seen across the board upward pressure on inflation. Now, a lot of this is to do with higher energy costs and higher commodity costs. Obviously, Canada's goods are very much in high demand right now, as Ukraine has a very similar economy to that of Canada. And a lot of the things that we supply to the world, Ukraine also supplies. So we're seeing more exports as a result. And basically what that is all leading to is it is leading to this situation where even though Russia, Ukraine doesn't have a huge impact on us locally, it has a huge impact on us from an inflation standpoint, and that is causing obviously interest rates to go up. Now, obviously that added upward pressure on inflation leads to higher interest rates. And this is where I really, really love what the Bank of Canada has done, because they're making it very clear what they think the neutral range of interest rates is going forward. So if you go ahead here and you take a look at their press release, here's the quote: "Canadians should expect interest rates to continue to rise towards more normal settings. By more normal, we mean within the range we consider for a neutral rate of interest that neither stimulates nor weighs on the economy. The neutral interest rate isn't something we can measure directly. We have to estimate it. And our estimate is between 2 and 3%. Today, we raised the policy rate to 1%, still well below neutral. This is also below the pre-pandemic policy rate of 1.75%. So what does this all mean? This is a really, really telling piece of information and data. So first and foremost, what you need to understand is the Bank of Canada's mandate is not to target interest rates, it's to target inflation and to get it around 2%, specifically between 1 and 3%. And what they're suggesting here and what they're estimating is the interest rate that it's going to take to get inflation to that rate. And what they're saying is that neutral interest rate is between 2 to 3%. So that, combined with their stated expectation that they expect inflation to come back towards that 2% range around 2023, indicates that we could see interest rate increases in their estimation right now of between 1 and 3%. So that would put the overnight lending rate at 3%, should they have to go to the full extent of those interest rate increases. And to expand on that comment, they went on to say, it is important to remember that we have an inflation target, not an interest rate target. This means Governing Council is not on autopilot to a preset destination for the policy interest rate. How high rates go will depend on how the economy responds and how the outlook for inflation evolves. So what that means is if inflation responds to these first 0.5% and 1% interest rate increases, well, there is a chance that interest rates may not go up a bunch. And if you look to somebody like Benjamin Tell from a few months ago, he's indicated that he believes, or at least at that point in time, he believed that interest rates were highly sensitive at that point, and that could very well be the case. However, if inflation does not respond to the interest rate increases, we could see them going up to the higher end of that level or even beyond it in order to bring inflation under control. So what that means is, the reality of it is this, is we need to change our behaviors. And what the Bank of Canada is hoping that we do is we change our behaviors as a result of higher interest rate costs. And that's why they did a jumbo hike right now, because they're trying to put a halt to the buying frenzies that are Canadian consumers right now in this moment. And hopefully what happens as a result is people will realize that borrowing costs are going to be more expensive. They're going to borrow less money, and therefore they will stop spending as much as they have been, and inflation will start to come down. Combine that with hopefully very soon, we see supply chain issues start to filter their way out, and they already have. There's some charts in the monetary policy report, if you want to look at them, that indicate this. And we start to see this whole inflation thing start to work its way out of the economy. Now, obviously, that's going to depend on a lot of things, including Russia and Ukraine not escalating any further than it already has, among other things with respect to supply and obviously COVID lockdowns in the future and so on and so forth. So while this may not seem like good news, it really is good news, because the Bank of Canada is taking square aim at inflation and trying to get pricing controls back to normal so that we don't find ourselves ourselves in a year or 2 or 3 years in a situation where we've got even higher inflation and higher interest rates and a way bigger problem. And it looks as though central banks around the world are going to follow suit. The Bank of Canada was the first to move this morning. New Zealand's central bank followed. It is widely expected that the Federal Reserve in the US is going to increase their interest rates by 0.5 point as well. And hopefully this will start to affect people's buying decisions. It will start to affect their borrowing decisions, and we'll see inflation start to abate. Now, many of you who have variable rate or adjustable rate mortgages are probably sitting there going, what do I do? Well, I've had several conversations with people across the country today, people in the industry, consumers, and there's a few things that come to mind here. So first and foremost, let's start by having a real conversation about this. If you are a fixed rate mortgage holder, you are not safe from upward interest rate pressure. Yes, if you have a fixed rate mortgage, you've got however much time is left on that mortgage where your interest rate will be the same. However, if interest rates do go up to that upper bound of what the Bank of Canada is suggesting, you'll see about a 2% interest rate increase, maybe even a 3% interest rate increase at renewal, which means you will face what's called payment shock. Now, think back to 2008. This was a major problem in the US where people saw their interest rates on their adjustable rate mortgages go up pretty much overnight. And as a result, they ended up in a really bad situation. A lot of the foreclosures in the US happened when adjustable rate mortgages reset. And let's be clear here, a 5-year fixed mortgage in Canada is really a 5-year adjustable mortgage. It is going to adjust in 5 years. So if you're sitting here thinking, I chose a fixed rate mortgage, I'm good, I don't have to worry. Well, what you need to be doing at this moment is figuring out a plan for the next 5 years. And what that means is you need to look at where interest rates are now and where they're going, and you need to start saving so that if interest rates do go up substantially, you are in a position that you can subsidize them by taking advantage of your lower payment now and putting money aside. And keep in mind, you qualified at 5.25% when you got that mortgage, so you should be able to save some money over and above what you're spending on your mortgage. That is just built into the qualifying process, but it's up to you to set up that plan right now. What I recommend that you do is you set up a savings plan immediately, whether it's into a TFSA or whether it's into some other investment account, and you start pulling whatever the difference is between your 5-year fixed rate and 5.25% is, and you put that away into an account automatically. You just get the bank to take it, move it, and you don't touch it until your mortgage comes up for renewal. By the way, if you're in a variable rate mortgage, and this is a traditional variable rate mortgage, so the type you would get from the major banks, this is the one where you have a fixed payment, not a payment that adjusts, you're in the exact same boat. So what that means is you need to take the same advice I just gave to the people who have the 5-year fixed mortgage, and you need to be setting aside money because it could be even worse for you at renewal time, because as interest rates go up, your payment isn't going to go up, but the amount of interest you're paying is, and the amount of principal you're paying is going to be less. And as a result, when your mortgage comes up for renewal and you have to reset back to that original amortization, you are going to end up in a situation where you could have an even greater payment shock than what somebody who has a 5-year fixed has. Now, if you have an adjustable rate mortgage, this is a little bit more simple for you. You're going to feel the pain of the interest rate increases gradually over time. And that's a good thing because it allows you to get used to them over time rather than feeling them all at once when your mortgage comes up for renewal. But you should be doing the exact same thing. Figure out what the difference is between a 5.25% payment is and what your payment is now, and start putting that aside. And if it comes time where you need to subsidize your mortgage payment, you will easily be able to do that. Now, as for locking in your mortgage, there's a few things you need to understand. First and foremost, the lock-in rates right now are around 3.8 to 4%. If you lock in, you're exposing yourself to payout penalty risk. And there is a chance that we could see fixed rates come down or short-term fixed rates come down. There is, with near certainty at some point in the future, going to be an opportunity to switch into a shorter-term fixed rate mortgage midterm and save some money. But if you lock into a 5-year fixed rate now, you're going to expose yourself to some penalty risk, and you may end up not being able to get into those lower rates in the future, those lower short-term fixed rates. In addition to that, you've still got about 1.6 to 1.8% in interest rate hikes before you would get to the lock-in rate. So it would be better to put the money aside into savings, maybe let it grow a little bit, than it would be to lock into that fixed rate mortgage, because you're still going to have all of that time where you're going to be able to save money. And let's say it's 6 to 7 more interest rate increases that would have to happen before your variable rate reaches where fixed rates are today. Well, all of that time is time that you will be saving money, and then you're going to need a whole bunch of interest rate increases after that in order to cancel out all of the time that you've been saving. So right now, variable still makes a ton of sense, even with interest rates going up. And the reason for that is quite simple. It's because the bond market and therefore fixed rate mortgages have already priced in these interest rate increases for the most part. Now, if it's really going to keep you up at night, it's probably a good idea to lock in. If you want to know what your payment is for the next 5 years, you don't want to have to worry about it, that's fine. Make sure you also have a plan for when you have to renew that mortgage. But ultimately, at the end of the day, if you're putting money aside that is comparable to the difference between what your interest rate now is and what interest rates are going to be, that should give you significantly more security and more peace of mind than having that fixed rate mortgage, because you'll know that you have the cash on hand to weather a storm in the future. If you just choose a 5-year fixed rate right now, well, guess what? Interest rates go up, interest rates go down. If all of your money is going into your mortgage, then, and you don't have cash to put aside, well, you don't have the cash to weather a financial storm in the future if we get there. Now, I still believe that there's a chance we may not see interest rates go all the way to where we expect them to, or where the Bank of Canada is suggesting they could. I'm sincerely hoping that interest rate sensitivity in Canada is high. By the way, to all my realtor friends and all my mortgage friends who are out there saying, no big deal, don't worry about it, everything's okay, please stop saying that, because the whole point of these interest rate increases is to get people to change their behavior by making them really think about and realize what is happening with interest rates and the fact that borrowing costs are going to go up, and it's time to stop spending money. Just stop spending dough like it's no big deal, because it is a big deal. It's time to realign our finances, get smarter about saving money, get smarter about our mortgages, and really put ourselves in a good position for if this thing gets significantly better, or it does the opposite and gets a little bit worse. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about that race to 25,000 subscribers. We'll see you on the next one. Cheers.